SCHD is one of the most popular ETFs in the world right now, with some people basing their entire personality off of it. What makes the ETF so special? So today we will be doing an in-depth review and analysis of the SCHD ETF. And let me know in the comments section how much SCHD do you own in your portfolio. Currently, I'm sitting around $1,800 worth of SCHD right now, making up roughly 11% of the portfolio. If you like high return investments like SCHD, the best high return investment that you can actually buy is free, which is hitting that subscribe button for me. With all that out of the way, roll the intro.
Hello, I like money.
The most important thing I think for investors to realize and understand when investing in an ETF is the expense ratio. If you have thousands of dollars invested into an ETF, it is very easy for your expense ratio to eat away at a majority of your gains. Take a look at ARK, for example. Kathy Wood, who instead of selling ETFs should be selling hot dogs on the side of the road. ARK funds have a 0.75% expense ratio, which is absolutely nuts. So for every $10,000 that you have invested in an ARK fund, you're getting $75 taken away every year in expense ratios, which is absolutely nuts. SCHD's objective is to track as closely as possible the total return of the Dow Jones US Dividend 100 Index. Schwab highlights it as a tax-efficient ETF to own. It tracks the quality and sustainability of dividends, so it's not investing in companies like Intel, and actively manages and watches companies' performance to see if that dividend is sustainable and if the growth is sustainable, more importantly. And they look at fundamental strength in companies and stocks overall compared to the peers in their sectors. How does SCHD actually find stocks to be put into the ETF? To start off, they must have 10 years of consecutive dividend payments and growth. The company must have a minimum float-to-market capitalization of $500 million. Schwab also looks at the fundamentals of the business itself, its cash flow to depth, free cash flows, revenues, financials, etc. Also, no single stock can represent more than 4% of the SCHD portfolio itself. So if one company just completely shits the bed, SCHD doesn't tank as a result. The stocks also must meet minimum liquidity criteria. SCHD has actually only been around for 12 years, so unfortunately there isn't a whole lot of data to prove the complete long-term success of SCHD, but looking at most of its stocks, they do long-term outperform the market. The fund's manager is Farian Jamunu. Year-to-date, SCHD is down 2.1% compared to the market, which is up this year. This is mainly because of SCHD's high exposure to financials and banks, which have had a tough year, and healthcare as well, which have gone down this year. SCHD also has a lack of exposure to technology, which has ran up this year. Over the last 3 years, their annualized total return is 15.3%, and their 5-year annualized total return is 11.5%. So very solid and outperforming the S&P 500 in those respective areas. Compared to other dividend ETFs, SCHD pretty much outperforms all of them except DGROW, which barely outperforms SCHD. A big thing to keep in mind though is SCHD's dividend is much better than DGROW's in terms of yield and growth. Year to date though, SCHD is drastically underperforming the S&P 500. Again, this is mainly because of SCHD's lack of exposure to technology and SCHD's big exposure to banks and healthcare, which has gotten beat up a lot this year. This is all expected though, and if you're a long-term SCHD shareholder, there's nothing to be worried about. But let's take a look on a longer time frame to really see how SCHD compares to the S&P 500. We can see since 2012, SCHD's total return has actually outperformed the S&P 500's total return. This is also due to the SCHD's high dividend yield and high dividend growth in that time frame as well, leading to better shareholder return. Now let's talk about SCHD's impressive dividend growth. Since 2016, SCHD has nearly doubled its dividend payment annually, with strong year-over-year growth, recently getting up to nearly 20% as high in 2019, but annual payout growth ranging from 10 to 15% in the last few years. You would not have had to hold SCHD for a very long time just to see the dividend snowball in effect already today. Usually for dividend growth ETFs and dividend growth stocks, the dividend yield itself is pretty low, but with SCHD that is definitely not the case, with a dividend yield currently at around 3.6%. SCHD's dividend growth rate is 16.63%, which is incredible, with a 3-year CAGR at 13.33%, a 5-year CAGR at 15.56%, and a 10-year dividend CAGR of 11.72%, SCHD is definitely one of the best dividend ETFs for dividend growth alone. Now, one thing to keep in mind when looking at SCHD's dividend history itself is that from quarter to quarter, the payments are not consistent and they are not the same. But over time, SCHD's annual dividend payout that you get every year, which is all 4 quarters added, will be growing. This is mainly due to the dividends that SCHD actually gets from the individual stocks that it owns. Some months they get more dividends than others. It's just like us. SCHD has paid their dividend for 10 years straight, and they've also grown their dividend for 10 years straight. It will be interesting, though, once we go into a recession, eventually it will happen, how SCHD will hold up and stand. They do own a lot of slow, boring companies, which typically during a recession do better. I think SCHD's dividend not only offers really attractive yield, but also a really attractive growth rate as well, which will eventually lead to compound interest doing its work and the dividend snowball be rolling for decades to come if you hold. Now I'm going to go over all of SCHD's holdings real quickly. A new one that I'm very fond of, which is AbbVie, sitting at 4.26%, Cisco, Pepsi, Broadcom, Pfizer, Texas Instruments, which is an amazing company, Coca-Cola, Verizon, which is a much slower grower. I don't love that, but again, it offers good yield. UPS I love, Home Depot I really like, Amgen, Merck, Chevron I really like, Lockheed Martin, BlackRock, which owns everything, Automatic Data Processing Incorporated, Altria, Illinois Tool Works, EOG Resources Incorporation, Blackstone, 3M, Valero Energy, U.S. Bancorp, Ford, Kimberly-Clark, Newmont, Paychex, Fastenal, Allstate, Onkirk, T. Rowe Price, Linden Basal Industries, M&T Bank, Carrera Energy, Darden Restaurant, Fifth Third Bancorp, Northern Trust Corporation, Tyson Foods, Regions Financial Corporation, Kellogg, Ancor, Best Buy, Regions Financial Corp, Huntington Bancorp Incorporated, Interpublic Group of Companies, Snap-on, International Paper Corp, Packing Corp of America, which I just talked about in my most recent video about Citizen of the Year's portfolio. Very interesting company. KeyBank, Paramount, and Watsco. I would like to personally see a little more dividend growth focus in this portfolio, but at the same time, there are some very strong positions that you diversification. Right now, the largest stock in SCHD is currently Avgo, which is Broadcom, which is a very high quality company, making up 4.32% of the portfolio. Then we have Cisco Systems, UPS, which I'm a big fan of. They do a lot of rewarding with the shareholders through buybacks and great dividend hikes. PepsiCo, an amazing quality company. Coca-Cola, Verizon, which I don't love as much. Merck & Co., Texas Instruments, which is a very strong company as well. Pfizer, and a new addition which they added in March, which is AbbVie, which I'm a big fan of as well. I think long term they're going to move away towards more of those higher yield or higher risk stocks with lower stock performance, kind of like Verizon. But overall, I think that's going to be the long-term game plan for SCHD, and it will be the right one to make. Now here's SCHD's sector diversification. Coming in at the largest part of the portfolio is industrials at 17.77%. Then healthcare, which has been underperforming this year, 16.26%. Financials, which have been underperforming this year at 14%. Consumer staples at 13.3%. Information technology at 12.5%. Energy at 9.27%. Consumer discretionary at 8.14%. Communication services at 4.94%. Then we have materials at 3.44%. And lastly, a very small stake in utilities at 0.28%. One big thing to realize when you're investing in SCHD is you have no real estate diversification. Today, SCHD just announced their new dividend payment for the month of June, and unfortunately, it was less than last year's June. The reason for this, though, mainly is probably the portfolio reconstruction, which happened in March. They're going towards more growth-oriented stocks, which in the long term will be the right move. Also, as well, the payout dates could be different for some of the stocks that they added to. Of course, to see what the growth rate is, we'll have to see the annualized dividend payments, which is the 4 quarters combined at the end of the year. Overall, though, I think SCHD is a great dividend ETF and a great ETF overall, not only for great dividend yield, but great dividend growth as well. You're also getting access to some of the highest quality companies in the world. Alright guys, that will wrap up the SCHD ETF review. If you've made it this far from the top to the bottom of my heart, I really do appreciate it. Helps me reach my goal of hitting 1,000 subscribers by the end of the year. I want to thank you again. If you haven't already, make sure to subscribe, turn on post notifications, smash the like button while you're at it. Join the Discord, link in the description, to talk with like-minded investors. We have all sorts of conversations about SCHD on there. And lastly, of course, do dividend stocks, not drugs. Have a good one.